Hello, this is Keith Schneider, CEO of MarketCage.com, and this is February 14th edition of Market Outlook. Don't forget to go to our website and sign up for this, and you get the text and video version for free every week. All right, so market sort of swooned a bit, but stabilized and almost fully recovered, certainly in certain indices like the NASDAQ that was getting hit pretty hard. So let's see where we are. But there's definitely some very iffy and concerning things relative to equities that occurred, which we're going to get into. So first of all, when we talk about status quo, again, just looking at these charts here, right, you can see we're rolling over on the monthly. This is a 80 monthly moving average. We're trading below the 23-month moving average as well, which is this blue line. And these are very, very long-term trends. As you can see, it's actually sloping down. And in fact, the break through the moving average was on greater than normal volume on a monthly basis back in January. Now, there are some positive things, at least indicating that we could have a short-term bounce. Now, what happened here is you can see what I've done is I've put in a very critical support line where the bodies of the candles either opens or closes have held, ignoring the intraday spikes. And we have a really interesting support level that's quite obvious right around 187, right? And so we did close under it for the week, and the S&P was down 0.7%. So it is iffy, but we did get this bounce. If, in fact, we can close above, on a daily basis, above that 187 level, you've got an interesting swing point. So on an intraday basis, we may have flushed out all the week longs for now and mount a rally. Now, don't forget, though, we have a situation where we're in a bear phase already. And again, 196, 197 level, which is, a pretty substantial rally possible. So when we talk about the dead cat bounce, again, we got the 50-day moving average and resistance from a couple of weeks ago right around that 196 level. So definitely looking for potential resistance around 196, and you really should have a wall right around that 200 level if we get even a further bounce from there. So again, that's your key point there. On a longer term chart, the weekly chart here, let's not forget about that 200-week moving average. Now, what's interesting is the spikes, the intra-week spikes, coincide with the moving average. So 179 is critical. You could, if you breach that, have a vacuum to the downside. Our count, again, goes back to where the monthly 80-month moving average comes in around 154, and also support, right? The prior highs going back to 2000, 2001 time period, and 2006, 2007 all seem to coincide. So there should be really some decent support in that 155 to 160 level. So again, those are your points, right? And you want to be fluid here. You could get a potential rally, especially if we get some stabilization in oil and some of those bond, easing off of the rally and a resumption of some higher rates, which would actually be a good sign for the market. Let's take a look at NASDAQ. Similar situation in NASDAQ 100. We did close above that similar point we had put in the S&P, the 98 level, pretty critical we did close pretty much right on that support level. And again, it's good that we did close above 98 on the weekly basis. Again, support around 72.65 or so, and that would also coincide with the breakout in 2012 where all this compression took place. So in effect, if we break down from those important lows put in just in the last couple of weeks, we could be heading in for a lot more trouble. On the longer term chart, around that 72.65 level, a little bit higher on the weekly charts, which is around 87.50, where there is some support as well. So those are your two levels, 87.50 in the Qs, 72, 73. Now, one thing I do want to look at as well is the calendar ranges. Looking at QQQ, if we can get back above 99, 100, that would be a pretty good sign that we're back inside the 6-month calendar range set in January. But meanwhile, still under pressure. So possible small rally here. We want to really see this thing get above that 100 level, or certainly above 99.50, and at least the market will show some signs of stabilization. On the other hand, a breakdown of those new lows is problematic. Now, another slightly positive sign is that on Friday, we closed above the calendar range, the 6-month calendar range lows, just above it by Friday's close. So that's an early warning positive sign that it's in the favor of the bull camp. Again, certainly not out of the woods on a longer term basis. We'll get into that in a moment, but a short-term rally that could be sold. Of course, we can always reevaluate at that time, but that could be developing in the cards. Let's take a look at some of the market internals. As you can see, market internals, we did get overbought, started working off that overbought level. In fact, on the advanced declines, we did start getting a bit more towards the oversold levels. Not so in up-down volume. The McClellan oscillator, which is looking at over the next 2 to 3 weeks, really needs to cross back over the flat or the zero level, and we're sitting right here, right around minus 14. So overall, market internals slightly to the positive here in the fact that we're bouncing off what was moderately oversold levels. Now, of course, we can always flip down, and there's a lot more to go on the downside. However, the other factor in terms of market internals is this. You can see the volatility, although not nearly as bad as what happened in last August, has approached moderately oversold levels and turning up. So that is a moderate positive. So net-net, when I look at sentiment and the market internals, I'm looking at a situation where it's moderately positive in the fact that you might have reached a level from where we can bounce. So definitely want to watch that. The fact is that we did clear out on a daily basis some important closing basis support, and then close right back through it with the market getting moderately oversold in that sentiment reading. So slightly positive there. Taking a look at the absolute level of VIX. And as you can see, we did not hit those August peaks. So even with all of the panic and sell-off in the market and flight to safety, including that massive move in gold, volatility still has not breached the panic levels reached last August. So we're definitely in a bull trend in the trend on sentiment of volatility, which is a negative for the market, although potentially we got overbought on the Bollinger back inside. Again, this is a more positive reading for the market that the volatility, implied volatility of the options here are indicating excessive pessimism, which it now has backed down into. So again, this is a pretty critical level, because if we back out above through that Bollinger and the highs set on Friday, it'll take out the highs from August, and that will also confirm the recent overall trend in the market, which is down and increased volatility. But for now, we're definitely running a bit rich. So I would look at this as more of a positive for the market at the moment, unless that's negated by a move to new highs. Let's take a look at gold. And as you can see, this is sort of a pretty massive gold, probably a massive rally in gold. We had been talking about how that has moved up sharply. And even on Friday, with the market up 1.5% to 2% in equities, gold barely retraced. Now, we do have an inside day pattern. It's going to be in a 3-day weekend. It's going to be interesting to see what and if the central bankers can do anything to keep this panic into alternative investments, away from equities, into safety and alternative currency, which gold is now acting as. Now, are we in an overbought scenario? Yes, but I would not be surprised to see some sort of short-term pullback here, maybe holding support at that 112.50, 112.70 level, which is the 10-day moving average, and also the low of that consolidation before this breakout. This is pretty classic. This is a breakout, a flagging action, and another breakout. So longer term, this is definitely looking quite a bit more positive. Here's a chart we pointed out last week. This is the weekly chart in gold. And as you can see, we have an interesting channel. And it basically, last week, we took out the 65-week moving average and closed above it. We thought that it would really continue. And boy, ever did we get a great move. We moved from a 111 or just above that in last week, and this week a move all the way up to almost up to over 120 intra-week. So that's that's almost $100 move in bullion from closing prices. That's quite a substantial move. But more importantly, you can see that we've broken out on huge volume on this downward sloping channel and trend line. So clearly, next level of resistance is probably at 129, another $100 or so equivalent in gold bullion. And really like this volume pattern. As you can see, really strong volume for weeks now, for almost last 3 or 4 weeks. And that's the strongest volume that we've had, certainly above its average volume range, which is about 30 million shares per week. So that's pretty powerful move. In terms of accumulation, that's going back to 2012, that's the biggest buying we've had. Since oil is such an important component here, and the markets seem to, certainly the equity markets seem to be following the price of oil, I felt I should cover oil here. So one of the things is I'm introducing a new chart. One of the new charts here, this is a chart of the momentum of the price relative to the moving average. So as you can see, this is a chart up on top. This is USO, and USO, obviously you can see, is falling apart, moving against this downwardly sloped moving average. But this is the chart of price relative to the momentum of that moving average itself. And so, as you can see right now, the downward momentum relative to the long-term movement in USO, in oil, is basically flattening out. In other words, even though we're going down in absolute price, right, the momentum relative to the moving average, which is this blue line here, is stabilizing. And in fact, reaching the lows of where it was back in 2015, the early part of it. You can see on this huge drop, huge momentum to the downside relative to that moving average. And over here, we're basically at those same levels. So what we like to do is see the market make a new low, but not in terms of its momentum. And this is all relative to the 200-day moving average. So something to keep an eye out. If, in fact, we do get some additional strength here, it's very possible that we're bottoming out in oil. And what I'd like to see is probably another 40 or 50 cents up, or certainly a move above that 10 level and in USO. And I think we would certainly say that the downside momentum is exhausted and the price movement has confirmed. So that's your earliest sign here, is that the momentum of the price relative to the downward sloping moving average, right? Even though we pretty much made a new low, we did not do that in the momentum of the price movement. So very possible bottoming action in oil. So let's keep an eye on that. I'll be updating you on this new type of indicator as time moves on, but we're pretty excited about adding this new level of analysis to our inventory. Well, that's pretty much it. Thanks. Bye for now, and see you next week. And again, stay frosty, because markets are going to be extremely volatile. I could certainly see a potential bounce here, certainly if the oil stabilizes, and we could get a pretty sharp bounce. Although the bigger picture, there's definitely stuff underfoot that's causing, this panic into lower interest rates, almost negative interest rates, or negative in some cases. So definitely cause for concern. Gold definitely looks like it's in play, not going away. And there you have it. All right. See you next week.